Why silence is the most expensive financial mistake. Hello, everyone. Let's begin with something very familiar. A payment is due. Life intervenes. Work, family, health, stress, everything pile ups at once. And in that moment, sometimes the easiest response feels like doing nothing. No answering the phone, not opening the emails, not dealing with it today. But in the world of mortgage, credit, and lending, silence is not neutral. Silence sends a signal, and it is rarely the signal you intend. In this RadioArya episode, I am going to explain why silence often turns a manageable financial issue into a serious problem, how lenders interpret it, and how simple conversation can protect your credit, your options, and your future. This is Radio Arya, Real Estate and Mortgage Basics for Smart Investing. The disconnect. Let's look at the core issue. On one side, there is your reality. You may be feeling fear, you may be feeling shame, you may be overwhelmed and unsure what to do next. But on the other side is the lender's reality. And this is critical to understand. The lender does not see your emotions. They don't see your stress. They don't see your intentions. They see only three things: a missed payment, no communication, a rising risk indicator. This disconnect between how you feel and how the system interprets your silence is where a small problem becomes crisis. Why people go silent? It is important to say this clearly. Going silent is not about being irresponsible. It is a deeply human reaction to pressure. People go silent for very normal reasons: fear of hearing bad news, shame about admitting difficulty, hope that the issue will fix itself, not months, emotional exhaustion from carrying too much at once. Silence feels like temporary relief, but financially it creates long term damage. How lenders interpret silence. Here is the hard truth. In finance, silence does not mean stress. Silence does not mean fear. Silence means risk. An uncommunicative borrower is an unpredictable borrower, and lending systems are built to react to unpredictability. This is not personal, it is procedural, it is regulated. Once silence appears, systems begins to move automatically. The timeline of escalation. Let's walk through what actually happens when communication stops. First 15 days, late fees are applied. Interest continue to accrue. Credit score may dip slightly. At this stage, the damage is small and reversible. After 30 days, this is major turning point. The account is officially marked delinquent. Credit bureaus are notified. Credit scores can drop significantly. Access to new credit, refinancing, and even insurance rates can be affected. After 60 to 90 days, the situation escalates rapidly. The file moves out of customer service. Internal collections departments become involved. Legal teams may be alerted. Silence is interpreted as non cooperation. At this stage, stress multiplies fast as a payment issue becomes a systematic problem. Problem versus crisis. This distinction matters. A missed payment is problem. A missed payment combined with silence becomes crisis. And that crisis unfolds in the three ways. You lose negotiation power. The lender assumes the worst and limits options. Process accelerate. Regulation requires action when risk appears. Long-term credit damage set in. Effects can last for years. Again, this is not punishment, it is risk management. Silence is the trigger. It is not personal. This is important to understand. Lenders are not being cruel. They are not being emotional. They are not making moral judgments. They are operating under strict rules. When risk is detected, they must act. Silence is what signals that risk. The turning point, communication. Now for the most important part. Lenders expect hardship. They know people lose jobs. They know people get sick. They know life change. They have systems, departments, and tools for hardship. What they do not have tools is for silence. When you communicate, options reopen. Payment deferrals, interest-only period, temporary restructuring, modified repayment plans. Communication slowed the system. Silence accelerated. How to take control? A very practical steps. If you feel overwhelmed, start here. Step 1. Communicate early. Earlier contact means more flexibility. Step 2. Be honest, not perfect. You don't need a solution, just clarify. Step 3. Seek guidance. A mortgage agent or financial advisor can help frame the conversation. And if you don't know what to say, use this sentence: I'm facing temporary difficulty and I want to discuss my options. That sentence alone change how your file is categorized from high risk to cooperative hardship. Final message. Let's end with this. Financial difficulty is not a personal failure. It is part of real life. What creates lasting damage is not the setback, it is ignoring it. In real estate and mortgage decisions, communication is leverage. Use it. Thank you for spending your time with Radio Arya. If this discussion helped you understand the system better, subscribe, share it with someone who needs it, and join us for the next episode. RadioArya, Real Estate and Mortgage Basics for Smart Investors. Thank you.